Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about PriceSmart Inc. quarterly report. PriceSmart Inc. market capitalization of $4 billion is materially smaller than most of its industry peers of roughly $32 billion. PriceSmart Inc. trades at a lower price-to-earnings ratio of 26 times and a lower price-to-book ratio of 3.07 times relative within the industry. But when we look at the broader industry, much for its peers are also priced fairly or higher. This indicates an overall sector-level optimism, suggesting that most investors have already participated in the industry, leaving limited opportunity to uncover undervalued stocks. The company maintains a moderate leverage profile, with liabilities making up 45% of total assets, suggesting a balanced approach between risk management and capital efficiency. Average liabilities have increased over the past 5 years, which is normal for a growing company. Asset and equity growth have outpaced liabilities, suggesting balanced and healthy expansion. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The company has consistently reduced its share count, while revenue and equity have grown, indicating disciplined buybacks that enhance long-term per-share value. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. PriceSmart Inc. provides a wide range of products and services to its members through its membership shopping warehouse clubs. The company's offerings include basic and private label merchandise such as groceries, cleaning supplies, health and beauty aids, meat, produce, deli, seafood, and poultry. In addition to these products, PriceSmart also offers electronics, large and small appliances, automotive, hardware, sporting goods, seasonal products, clothing, domestic, and home furnishing items. The company's product range is extensive, catering to various needs of its customers. Beyond its vast array of products, PriceSmart also provides services such as food and bakery services, health services including optical, audiology, and pharmacy services. Members can also take advantage of the company's e-commerce platform, curbside pickup, and delivery services for added convenience. Overall, PriceSmart Inc. is a one-stop shopping destination that offers an impressive range of products and services to its members, making it a popular choice for those seeking value and convenience in their shopping experience. The significant increase in PriceSmart Inc.'s stock price by 44.8% within the past year can be attributed to a combination of factors. One key contributor is the company's robust revenue growth, with net merchandise sales increasing by 7.7% to $5.15 billion for the full fiscal year 2025. This growth is evident in the first quarter of fiscal year 2026, where net merchandise sales climbed to $1.35 billion from $1.22 billion in the prior year. PriceSmart's strategic expansion initiatives have also played a crucial role in driving investor confidence. The company has continued to expand its physical footprint by opening new warehouse clubs across various countries, including Guatemala and Costa Rica. This expansion aims to reach a total of 60 clubs by fall 2026. Furthermore, PriceSmart has seen an increase in membership accounts, surpassing 2 million in fiscal year 2025, with platinum membership penetration rising to 17.9%. The growth in digital channel sales is another significant factor contributing to the company's stock price appreciation. Digital channel sales have shown strong growth, rising 21.6% year-over-year in fiscal year 2025 to $306.7 million. Additionally, PriceSmart announced an 8.6% increase to its annual cash dividend in February 2025, reflecting confidence in the company's cash-generating activities. While individual quarterly earnings reports presented mixed results, the overall trend of expansion, membership growth, and consistent revenue increases has driven investor confidence and contributed to the stock's appreciation over the past year. The primary drivers of revenue growth and decline for a company can be attributed to several key factors. Revenue growth is primarily driven by an increase in net merchandise sales, membership income, and other revenue streams. The expansion of warehouse club openings, entry into new markets such as Chile, and the adoption of online shopping through mobile apps and websites have also contributed significantly to revenue growth. Additionally, the company's Click and Go service has seen increased adoption, while membership account growth and an increase in platinum membership base have further boosted revenue. On the other hand, revenue decline is largely due to a significant decrease in export sales, which plummeted by 98.7%. Currency fluctuations in the Caribbean segment also had a negative impact on revenue, with a devaluation of the Dominican peso contributing to this decline. Net income and profit margins. A mixed picture. The extracted summaries reveal a complex picture of how net income and profit margins changed over time. On the one hand, net income increased significantly from $37,428 in 2024 to $40,166 in 2025, representing a 7.5% increase. This upward trend continued into CONE 2026, where net income rose by $4.6 million compared to the same period in 2025. However, profit margins tell a different story. Operating margin decreased from 4.63% in 2024 to 4.55% in 2025, while net profit margin also declined from 2.97% to 2.9%. This suggests that despite the increase in net income, companies may not be generating profits at the same rate as before. On a more positive note, total gross margins increased by 11.2%, indicating that companies are able to maintain their pricing power and control costs effectively. Additionally, operating income as a percentage of total revenues improved from 12.8% to 13.1%. These mixed results highlight the need for closer examination of financial data to understand the underlying drivers of these changes. The company's financial performance indicates a significant improvement in its ability to generate cash from its core operations. The data on page 8 reveals that the net cash provided by operating activities has increased substantially from $38,530 in 2024 to $71,245 in 2025. This substantial increase suggests that the company is becoming more efficient in managing its day-to-day operations and generating cash flow. This positive trend in operating cash flow is a significant indicator of the company's financial health. It implies that the company has sufficient liquidity to meet its short-term obligations and invest in growth opportunities. The increase in operating cash flow also suggests that the company's management team is effectively implementing strategies to optimize profitability and reduce costs, leading to improved cash generation. The company's debt level and interest expenses have undergone significant changes. On the one hand, current liabilities have increased from $726,271 in 2024 to $788,900 in 2025, indicating a rise in short-term debts. Conversely, long-term debt has decreased from $147,922 to $143,735 over the same period. However, a closer look at the data reveals that short-term borrowings have skyrocketed from $75 million to $171 million between August 31 and November 30, 2025. This substantial increase in short-term debt is likely to put pressure on the company's liquidity and financial stability. In terms of interest expenses, there has been a notable increase of 22.2% from $1,622,000 in 2024 to $1,975,000 in 2025. This rise in interest expenses suggests that the company is paying more for its debt obligations. The significant jump in short-term borrowings may be contributing to this increase in interest expenses. Overall, while long-term debt has decreased slightly, the substantial increase in short-term borrowings and corresponding rise in interest expenses are cause for concern. These changes suggest that the company's financial situation is becoming increasingly precarious. The performance of various segments and regions within the company has been a subject of concern. In terms of cash and cash equivalents, foreign subsidiaries have seen a decline from $222,770,000 to $215,390,000. This trend is also observed domestically, where cash and cash equivalents decreased from $62,521,000 to $34,167,000. The regions that are facing liquidity challenges are Trinidad and Honduras. These areas have struggled with maintaining sufficient cash reserves, indicating potential financial difficulties. The decline in cash and cash equivalents across both foreign subsidiaries and domestic operations suggests a broader issue affecting the company's overall financial health. Management's outlook on company strategy. The company has outlined its growth strategy, focusing on three key drivers: expanding locations, increasing membership value, and driving sales through digital capabilities. This includes opening 4 new warehouse clubs in 2026, investing in remodeling current clubs, and adding distribution centers. Additionally, the company aims to expand into new markets, such as Chile. Management is also prioritizing technology and executive compensation, while emphasizing its commitment to being a good corporate citizen through philanthropic efforts. The company's financial management strategy involves effectively managing cash and investments, with a focus on non-GAAP measures like adjusted EBITDA for evaluating core operating performance. Overall, management is confident in the company's ability to recover income tax receivables and deferred tax assets, indicating a positive outlook for future growth and profitability. The company has demonstrated a commitment to returning value to its shareholders through various means. One key aspect is the payment of dividends, which indicates that the company is generating sufficient profits to distribute a portion of it back to its investors. In fact, the company declared an annual cash dividend in the total amount of $1.26 per share for fiscal year 2025. In addition to paying dividends, the company has also engaged in share buybacks, which allows it to reduce the number of outstanding shares and potentially boost earnings per share. This strategic move is a testament to the company's confidence in its future prospects and its desire to create value for shareholders through increased profitability. There are concerns about inventory buildup or supply chain disruption, as evident from various points in the summary. The cost of goods sold for net merchandise sales increased significantly from $1,029,877 in 2024 to $1,138,182 in 2025, indicating a potential issue with inventory management. Furthermore, estimated inventory losses and obsolescence, based on a percentage of sales, page 13, suggest that the company may be struggling to manage its inventory effectively. Additionally, the company experienced inventory markdowns on certain non-food product categories in Q3 FY 2022 due to the COVID-19 pandemic, page 40, which could indicate a vulnerability in the supply chain. The summary also highlights specific instances of supply chain disruptions, including roadblocks in Panama and Guatemala, October-November 2023, and delays in importation clearance in Nicaragua, May-June 2023. Moreover, U.S. dollar liquidity challenges in certain markets such as Trinidad and Honduras, page 57, could further exacerbate the issue. Overall, these points suggest that the company is facing concerns related to inventory buildup or supply chain disruption, which may have significant implications for its operations and profitability. That concludes the financial summary for PriceSmart, Inc. Feel free to comment below, and I will be happy to answer them when possible.